Geopolitical competition has intensified dramatically in recent years, with major shifts occurring among the world's leading economic powers. The United Kingdom, in particular, is rapidly developing strategies to strengthen its relationship with China, driven by trade and security interests that face increasing challenges. Simultaneously, the United States is tightening its technological controls, targeting China's semiconductor industry to curb Beijing's growing technological ambitions. In a notable response, China has confirmed its reduced reliance on U.S. public debt, underscoring the escalating economic rivalry between these two superpowers. These developments are reshaping the global order, presenting intricate challenges for nations trying to balance their economic priorities with long-term strategic goals. In today's video, we'll delve into these dynamics. But before we dive deeper, make sure to like, subscribe, and turn on notifications to stay updated with ancient craft. Now let's get started. The global economic battle intensifies. As we step into the new year, the global economic conflict shows no signs of slowing. Western nations are reevaluating their strategies for 2025. Meanwhile, under the leadership of newly inaugurated President Donald Trump, the United States is gearing up for another trade confrontation with China. While the European Union, EU, maintains a firm stance against extensive cooperation with Beijing, nations like the UK, Italy, and Spain are beginning to recognize that engaging with China is essential for navigating the volatile global economy. This marks a significant departure from past confrontations, such as the heated exchanges between Western leaders and Chinese President Xi Jinping over human rights issues at the G20 summit. The UK, in particular, has shifted from a hardline stance to a more pragmatic approach, moving towards closer ties with Beijing. British Prime Minister Rishi Sunak is expected to visit Beijing soon, and Finance Minister Rachel Reeves is actively fostering deeper economic relations between the two nations. The impact of U.S. trade policies on the UK and EU. This shift comes amidst the lingering effects of Trump-era trade policies, including tariffs and pressure on Europe to increase imports of U.S. oil and gas. These policies have created significant economic strain, particularly for the EU, which faces challenges importing costly energy while grappling with weakened domestic markets. The UK, already burdened by Brexit's economic fallout, estimated at a £27 billion loss in export revenue, faces dual pressures: importing expensive energy and maintaining competitiveness in an economically strained EU market. The UK's Labour Party leader, Keir Starmer, has warned against tariff measures, emphasizing the importance of sustainable trade relations with the EU. Currently, the EU accounts for over 42% of UK exports and more than 50% of its imports, highlighting the deep interdependence between the two economies. Challenges for small businesses and energy costs. The challenges extend beyond macroeconomics to affect small businesses, the backbone of the UK economy. In 2022 alone, over 16,000 small UK businesses ceased exporting to the EU, with exports falling by up to 40%. Larger companies have fared better, but the overall decline in UK exports persists, emphasizing the need for new cooperative trade policies. The EU too is under pressure. Importing high-cost energy from the US is increasing production costs, exacerbating economic challenges within the bloc. NATO's demand for member nations, including the UK, to increase defense spending to 5% of GDP adds further strain. If these funds are channeled primarily into military expenditures, they offer little benefit to the broader economy. Meanwhile, the European Union faces significant financial challenges, making stronger trade ties with the region increasingly impractical. As a result, much like its EU counterparts, the UK finds itself pivoting toward China, an economy that continues to grow steadily while strategically distancing itself from the United States. In this context, reassessing the UK's trade strategy becomes crucial. The United States remains the UK's largest trading partner, with trade volumes exceeding $100 billion. However, China has emerged as a key player, ranking as the UK's second-largest import partner with a trade value of $56 billion. Notably, China supplies essential low-cost goods, a critical factor in mitigating the impact of US tariffs. Although UK exports to mainland China totaled $21 billion, adding Hong Kong's $10 billion contribution brings the total to $31 billion, cementing China as the UK's second-largest market for goods. The UK's growing reliance on the Chinese consumer market is evident, especially as China develops its domestic economy and reduces dependency on the US. This evolving dynamic is pivotal for the UK as it seeks to secure its economic future in an increasingly complex global landscape. For the UK, diversifying trade and reducing dependence on the US has become an imperative. By 2025, if the US enforces severe trade barriers, strengthening ties with China may become a critical survival strategy. This shift aligns with a broader global trend that is likely to accelerate in the coming years. The UK is quietly undergoing a transformation, redefining its approach to global economic and political engagement. Trade and investment are now increasingly aligned with national interests. Notably, concerns about China's support for Russia have been overshadowed by more pressing economic issues, such as the decline of the UK's automotive industry. In the face of this crisis, the UK appears to be seeking collaboration with Chinese electric vehicle (EV) companies. The domestic automotive sector is under significant pressure, with production costs rising to unsustainable levels and technology, particularly in EVs, lagging years behind China. The historic Vauxhall plant in Luton, owned by Stellantis, faces closure, mirroring similar struggles across Germany. UK car production has plummeted by 30% compared to the previous year, marking 9 consecutive months of decline. From a peak of 1.8 million vehicles in 2017, production has fallen below 990,000 units in just 7 years. Adding to these challenges, U.S. America First policies under both the Trump and Biden administrations have encouraged reshoring of manufacturing, driving up energy costs for the UK and Europe and placing additional pressure on local industries. In this context, Chinese involvement in Europe's automotive sector may serve as a last resort to sustain the industry. The year 2025 is poised to be a turbulent one for the UK economy. Simultaneously, another front in the global tech war is escalating, focusing on the semiconductor industry. The Biden administration has intensified measures to curb the growth of China's chip industry, signaling the deepening of the chip war. Beijing is striving to dominate the global chip market, producing semiconductors for industries ranging from automotive and computing to defense and household appliances. In response, the U.S. has imposed restrictions on advanced chips and manufacturing technologies, particularly targeting companies like ASML and Tokyo Electron, to limit their exports to China. However, these actions have driven China to become more vigilant, especially in the legacy semiconductor market, where it controls over 30% of global production, a share projected to grow to 39% by 2027. Products relying on these chips, from TVs and laptops to electric vehicles, are predominantly sourced from China. China's growing dominance in chip manufacturing mirrors its success in the solar panel market, achieved through cost reductions and massive production capacity. By 2030, China is expected to produce 50 million 12-inch wafers annually, outpacing the combined output of the US, EU, and Taiwan. The West, led by the US, has responded with trade sanctions aimed at rebuilding domestic manufacturing capabilities and curbing China's global influence. However, the effectiveness of these policies remains uncertain. Chinese suppliers, offering chips at prices 30% to 50% lower than their Western counterparts, maintain a competitive edge due to supply chain efficiencies. This price gap continues to deter semiconductor companies from investing in the US, underscoring China's formidable position in the global tech landscape. Lower energy costs and greater control over domestic mineral inputs are reshaping global trade dynamics. Even the cost of shipping minerals from China to the US is significantly lower. In response, the US may impose tariffs on older Chinese-made chips, potentially ranging from 50% to 200%. While this measure aims to protect domestic manufacturing, it risks dividing the global market, creating two distinct systems, one for nations continuing trade with China and another aligned with the US's increasingly protectionist policies. By 2030, electronics are expected to account for half of a car's total cost, with electric vehicles requiring at least 3,000 semiconductors, including mass-produced chips. Higher production costs for domestically manufactured chips compared to those from Asia could lead to increased car prices for American consumers. This scenario might spark a global tariff war, resulting in two separate markets, one trading with China and another embracing US isolationism. As global trade undergoes significant changes, the decline in transactions between China and the US could have far-reaching consequences. One notable impact is China's decreasing reliance on the US dollar and reduced dollar-denominated foreign exchange reserves. China's holdings of US Treasury bonds have reached a record low of $760 billion, marking a $37 billion decline. Analysts predict that China will likely allow these bonds to mature or actively sell them, further challenging the US economy. Reshoring production to the United States presents high costs, with the Federal Reserve recently cutting interest rates and forecasting minimal additional cuts by 2025. The US government faces mounting financial pressures. Issuing more bonds becomes a challenge as borrowing costs soar. While G7 nations may remain net buyers of US bonds, Global demand is expected to decline as China strengthens bilateral trade ties. The U.S. Treasury yield curve shows signs of instability, with rising 2-year and 10-year bond yields. The 10-year yield now exceeds 4.5%, directly impacting U.S. interest rates. Meanwhile, China has begun issuing its own dollar-denominated bonds, drawing demand comparable to U.S. bonds. This intensifies competition in the bond market, as China can borrow U.S. dollars at lower interest rates than the U.S. government. The bond market is experiencing significant shifts. Chinese investors are increasingly purchasing dollar bonds issued by their government, reducing capital flows to the U.S. This strategy drives yields on Chinese dollar bonds below those of U.S. Treasury bonds, further reshaping global capital markets. These trends are expected to accelerate by 2025, as Western nations ease sanctions on China and Beijing seeks to disrupt the U.S. dollar system. The geopolitical landscape remains tense. As the U.S. presidential election approaches, analysts continue debating its impact on U.S.-China relations. However, many in China believe that tensions will persist regardless of the election outcome. From policymakers to ordinary citizens, there is a shared belief that any U.S. administration, Democratic or Republican, will aim to curb China's global rise, especially in the economic sector. During Donald Trump's presidency, his administration imposed tariffs on billions of dollars worth of Chinese goods and targeted companies like Huawei. Under President Joe Biden, the tone shifted towards stabilizing communications with China, yet core policies, such as investment controls and tariffs, remained consistent. Experts predict little change in U.S. policy toward China, regardless of the election winner. Key points include a continued focus on tariffs and restricting China's high-tech sectors like semiconductors and AI. Democrats leaning toward targeted measures, while Republicans may adopt more aggressive approaches. China's strategic response. To counter U.S. policies, China is expected to strengthen its domestic manufacturing, particularly in high-tech sectors, expand restrictions on critical mineral exports, promote the Belt and Road Initiative to secure strategic advantages, potentially depreciate its currency, undermining U.S. tariffs and complicating Washington's trade efforts. Additionally, Beijing might impose heavy sanctions on select U.S. Fortune 500 companies, or sell off a significant portion of its U.S. Treasury bonds. These actions could escalate tensions further, reshaping the global financial and trade systems. Thank you for watching. If you enjoyed this analysis, please like the video and subscribe for more updates. Share your thoughts in the comments. We'd love to hear your perspective. See you in the next exploration.